Hey, Ellen, it's Ray. How you doing
Hey
there?
Ray, I'm doing well. How are you?
All right, man. Coming at you live from New Orleans this time. I'm traveling. You're back in the Bay Area at home. And in my travels, I've been talking to some people. We've had some big news since our last hot episode on Saturday in the banking industry. People are asking me, is it safe out there? What do you think?
Is it safe? Yes, it's safe. It's very safe. It's so safe you wouldn't believe it. Is it safe? No, it's not safe. It's very dangerous. Be careful. Relax, relax. Come on, open. Okay, okay.
That hurt? No, I should think it would. Should take better care of your teeth. You have quite a cavity here. Is it safe?
Look, I tell you, I can't do it. You think he knows?
Of course he knows he's being very stubborn.
Please don't. No. No.
It's okay.
Huh?
Is it not remarkable? Simple oil of cloves, and how amazing the results. Life can be that simple. Relief, discomfort. Now, which of these I next apply, that decision is in your hands. So, take your time. Tell me, is it safe?
Please stop.
Wow, Ray, what a question, huh? We have to go to Dustin Hoffman, a marathon man, for the answer. I can tell you right now, it's not safe. Okay, oil clothes is not what we need here. What we needed was yesterday, Federal Reserve Chairman Jerome Powell needed to say, hey, pause on interest rates. Did not. Previously on avoid crisis, we said you must. Jerome Powell did not. Instead, raised the rates by a quarter point, 25 bips, right? So now what we have is even worse on the mark to marks with regional banks, and they're getting slaughtered. Let's just, it's not safe.
Yep.
What are your thoughts?
Look, they're so fixated on inflation that they're at first I think they were oblivious to the collateral damage. And once that became apparent and we had our first fatality in Silicon Valley Bank, then they chose to ignore it. And at this point, they are flat out saying, we're aware of it. Oh, don't worry. It's safe out there. And we have a little antidote here, the close FDIC. And so we can take care of it if we, no, we need bigger response. And honestly, we did. We called it well before that they needed to pause. They need to give the banking industry some thought and some breathing room. We need to go back to what we did in '08, which was not allowing shorts. We need to do some additional measures to help get these underwater treasuries to not have the impact that they're having on the balance sheet. And they're just not listening to it. They're just saying, "To hell be damned. We worry about inflation and unemployment. Someone else's problem is the banking industry." And I don't know who's at a high enough level that can oversee each of these sides.
Well, I think you're absolutely right on. I mean, we've been talking about this banking crisis. We've been talking about other crises. We have more crises to talk about. But
Hmm.
one of the things that we've cautioned our listeners to be thinking about is really listening to the information that they're getting and doing some fact checking on that.
Right.
We saw a couple of examples of that, and I'm going to start with something that happened yesterday, and I'm going to mention something that happened today. So something that happened yesterday was, we had the Federal Reserve meeting, and we had assurances coming from Jerome Powell saying, the banking system's resilient. What did we see in after hours? We saw another targeted bank, happens to be one coming out of Los Angeles, absolutely crushed in the after hours, 60% down. And that's not exactly showing that we have confidence in overall banks. And, you look over the past, 15, 20 years here and look at how many banks we had in total in the US to what we have now. It's something like 14,000 banks in the past 15 years is now down to 4,000. And we're losing a lot. Jamie Dimon comes out and says, this particular phase is past now that they're the auction winner at the First Republic. And all these things are things that we've talked about. I mean, in episode 9, we had a special episode calling out to the FDIC and the Federal Reserve to work in concert to try to stop the failure, which is really something that is the ricochet deposit flight that we talked about that started with SVB. And we even saw, the Fed report where they came out and they noted 4 items. Obviously, they noted the mismanagement at SVB, and hopefully there's going to be some repercussions for those individuals. But at the same time, they pointed out regulatory failures. And today we saw, a bank deal go south because it couldn't get regulatory approval. One deal will get approved right now. And, if you think about this, what is this? Is this going from, a very small set of banks is all that's going to remain when this is done? I mean, the contagion and fear that we talked about, and this goes all the way back to our earliest episodes. I mean, this is starting to get to be real. I mean, Main Street and Wall Street are disconnected at this point, and Washington doesn't seem to understand. And we've even called out the Federal Reserve and Jerome Powell. You mentioned, Jerome Powell needs to fall on the sword. Another thing you said, and I'm going to remind you of it, is you said this debt ceiling issue was going to come to roost sooner than we thought. And here we are with Janet Yellen mentioning. I mean, who's not listening? Who's not listening to this podcast, Ray?
Who should be?
If they're not, what's happening?
Well, that's one of the reasons we're doing this, Alan, is trying to get the word out there the best we can. So, let's just keep on doing what we're doing and see if people can catch up. But look, here's what's going to happen. The small community banks, pretty much every bank has these issues on their balance sheet. Combined with the fact that our banking system was never designed for large percentages of depositors to take all their money out at the same time. There's a certain stasis of money in, money out that's inherently assumed and built into our system. If anybody, and now with social media, with the meme stocks and what happened with GameStop and all we need now is social media influencers to all essentially collude with depositors to say, we're going to short the stock. You're going to take your money out. You're going to get all your money because it's going to be 100% FDIC insured. And then you're going to make money on the back end on the short sale. And then we'll tank another bank. Chase will pick it up and we'll just go do the next one and the next one and the next one.
Absolutely. The FDIC has hoodwinked us. Do you know what the definition of hoodwink is? It's to deceive or trick. And here's an example of that, an attempt to hoodwink the public. The FDIC has hoodwinked the public with this idea that we have some sort of safety in the system because they are basically like a hood robin. You know the story of Robin Hood, right? They stole from the rich and they gave to the poor. Right. Here, what we have is Hood Robin, which is the opposite of that. We have the poor little bank that's being handed over to the big bank. And what was their real issue? Their real issue was they were just the next in line after SVB. Where does this stop, Ray? Where does it stop?
Well, look at the deal. Look at the deal that Chase got on the First Republic assets, right? And what happened to Chase stock the day after that deal was announced? They popped like over 3%.
Yeah.
because everybody understood, wow, you got some pretty incredible assets for essentially pennies on the dollar.
Yeah.
And in the long run, your brand and your returns and your company are going to be way better off. You got a screaming deal on those First Republic assets. And that's what happened for not a hugely really good reason. If again, if the regulators understood what was going on, if the Fed understood, and if they coordinated their efforts to protect the banks and to protect the banking system and to protect consumers and quite frankly, investors as well at this point. Look, we're in an unusual time. Am I a big fan of banks and protect the banks? Heck no. Normally, you know, we're at odds with each other. We're on opposite sides of the table, right? But there are times, particularly in our system, where there are pieces, there are pillars within the system that have to be there for and everything to function properly. We've got problems now because of the long period of zero rates and the very short period of steeply accelerating rates that has caused a situation that needs nothing but time to work itself out.
Yeah. I mean, wouldn't it be great if somehow
Well,
they
time
were,
and regulation. Sorry.
yeah, I mean, wouldn't it be great if they were somehow able to go back and say, wait a minute, this whole approach that the FDIC is using isn't correct because all it leads to is more failures. And what they really need to do is they need to go back and say, hey, if you had this regulatory um, oversight issue, then what you have to do is you actually have to stop the process that doesn't work. They failed to come in at the right time. I mean, they should have closed this bank down as soon as they found out they didn't have a risk officer, right? I mean, that was a pretty obvious thing. After the MRAs go out there, how many of those do you have to be issuing before somebody says, hey, we're going to put them on a pause? That would
Right.
have stopped this. You couldn't stop then what started to happen and is going to continue to happen to other regional banks. We're going to see more failures. We called it before, and we were right. I mean, how many of these banks have to leave the system here and not be traded anymore? I mean, what investor? I mean, the investor right now kind of sounds a little bit like that clip, right? He's in the chair screaming, right? I mean, how many banks have failed so far that we, just this year? 23.
Wow. That's amazing.
One,
So,
two,
so
three. How many?
look, I have no idea. I don't know the exact number, but I will say this from an investor, from a equity investor's perspective, and I did not have this feeling a week ago. The banking segment is way too volatile to be involved in a long equity investment position, other than maybe two or three at the most five, with Chase being at the top of that list because when there was the deposit flight, they were by certain surveys, several surveys, the number one bank where depositors went. Some went to B of A, some went to Wells, city, the big guys. So you pick the three or four biggest banks, you go along there, and every single other bank that's publicly traded, get the hell away from until the system figures this out. But meanwhile, no, you're in that chair. If you're an investor, you are the one. Let's be clear here. You are the one in that chair. And this is what the system's telling you. They're telling you, oh, is it safe or not? They can try to throw FDIC insurance at you and say, oh, this will take all the pain away. But no, there's other stuff going on out there. So anyway, it's a bit of a mess. Um, all we can do is at this from where we're at is talk about it and see what's happening, adjust your portfolios, and carry on.
If you look at the valuations of these banks, it's almost like they had a stock split.
Yeah.
I mean, it's like they split. They were
Yeah.
at least worth twice as much just a couple months ago, right?
Right. And again, it's 100% created because of this black hole that's been created in the balance sheet because of underwater U.S. Treasuries. And there's a bit of it that's their loan portfolio. They did say 30-year fixed mortgages on real estate properties at whatever, let's just say 3%. Money costs them 5 now or whatever. And yeah, so they got a little problem there. But you know, um, most mortgages, you look at the data, 30-year mortgages don't ride out to 30 years. People sell the property. Um, Something happens, they want to get some equity out of it. You know, things happen. Divorces, people die, um, etc. And so a lot of those 30-year, by far majority of the 30-year fixed are settled out prior to 30 years. So this issue on the bank's balance sheets, the mortgages, you got to ride that through. The treasuries, something can be done about that. Another one would be, I believe, similar action has happened in the past. Have the U.S. Treasury say for banks only, if you run into a liquidity problem, we will lend you, Fed will lend you up to 100% of the face value, not the market value, the face value of that U.S. Treasury bond, underwater U.S. Treasury bond that's sitting on your balance sheet. So we're going to take this devaluation out of the equation on the liquidity side. There are things that can be done, but what kills me is they're not doing any of them. What the heck?
They're not aware. And when we talk about bank splits, as an example, we're not talking about banana splits. I mean, this is a pretty.
This thing's crazy. It is banana. It is, Alan. You are absolutely spot on. Banana splits, crazy. We were talking about this before, and Zach, were you able to? Yeah, you got it right on, Zach, our producer.
Wow.
There we go.
I'll tell you, I mean, that's the same thing that's happening with the banks, right?
Yep.
1 bank, 2 bank, 3 banks, 4. Yep. How many more, Ray? I mean, that kind of looked like, that's the FDIC and the Federal Reserve there in their costumes. They don't seem to be understanding that we're not in a tra-la-la moment.
Right. Yeah. Yeah. The next line was tra la 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 la. Right. Oh my God. That's a flashback for some of these older guys. Hey, for those of you who never heard of banana splits, man, you got to Google it. Watch a couple episodes. They were fun. They did have a lot of fun on that show. But yeah, in seriousness though, it's absolutely right. 1 bank, 2 bank, 3 bank, 4. I mean, how far is this going to go before we finally go? This is systemic within the whole system. It is pervasive. It's there. And the answer to that is regulation. Regulators adjusting rules to get us through this situation. I don't know.
Yeah, there needs to be money thrown at this problem as well, because I'll tell you something that, I mean, we've talked about this, about how many things that we've mentioned on this podcast that are later showing up, weeks later in the news, or that have been picked up by the news after we've mentioned it. We talked about Sudan. We talked about how we didn't feel, for instance, that the crisis and the biohazard was being understood or being picked up. And we also talked about how there was risk of, pathogens being exposed into the air. We talked about how even the ceasefire probably wasn't going to hold. It didn't. We talked about issues about the waterway that is going through there, and how much cargo is going through there, and how that impacts the worldwide economy. We talked before about how the contagion here is not just the U.S., it goes into the rest of the world. And what's happening? I mean, we're falling behind because we're not taking, our government isn't taking enough of a stance to try to fix this issue. And so, you gotta look a little bit deeper and kind of say, what else is going on? And I'm going to mention something here that, pretty soon, I'll predict it right now, pretty soon we're going to start to hear it being talked about on the business media. And that is the largest shareholder of the regional bank. You have to look at who is the largest shareholder of the regional bank. And here's what you're going to find. Almost invariably, the largest shareholder of any of these regional banks is going to be a hedge fund. Now, we know that even in our episode 9, we talked about how the bank balance sheet actually was a derivative. We're having that being proven out, right? But here's what ends up happening. If that hedge fund starts to get their investors saying, hey, return my money, then they have to sell. Just like the banks have to sell to pay off the depositors, the hedge funds have to sell in order to pay back those investors who say, give me my money back. And what are they going to sell? Are they going to sell the ones that are doing really well? Sure, they'll do that. But what are they going to do with their holdings in the regional banks? And we're not talking about small holdings. We're talking about they might have $200 million of investments in the largest shareholder of this bank. Well, if this comes down, just multiply the shares times the fall in these prices, and you know how much their hedge fund is getting dinged. By the way, some of these hedge funds actually own more than a single regional bank. In other words, you could have the same hedge fund actually being the largest shareholder in more than one regional bank. So those hedge funds are exposed, and they are probably some of the people that are selling, and they're going to go ahead and sell because guess what? Sell now, and then if, for instance, there is the short moratorium that comes out, they'll know it way in advance, and they'll be buyers, and they can go ahead, sell high, buy low, and make it back potentially. I mean, it's a risk, but more than likely, when they sell, they're not coming back in.
Part of what can happen here too is that as the stock price drops, the public perception changes. And now depositors, Alan, you're cutting out on audio, so I'm gonna go for a bit here, but.
Hey, hi everyone on the live broadcast. I'm producer Zach. Alan, could you talk right now? I think we lost Ray here. All right, I'm going to end the broadcast, everyone. We're going to start up again if Ray can rejoin. Alan, if you want to say.
I think